Everyone, and it's been a very busy 2 days, and I think as we are coming to an end of the conference slowly and to an end of the year, I think it's the right time to look ahead at 2025 and look for a new start. And obviously, we will be talking about money and about raising money in the current environment, and it is quite interesting point in time, I believe, from geopolitical, but also technological and innovation perspective. So how do we get it right? And I'm lucky, introduced, my name is Magda Krakowiak, and I will pass it on because we have a wealth of experience among the panelists here to talk a little bit. If you could introduce yourselves and in 1-2 minutes say, why are you essentially part of the panel, and why are you a believable person to speak about raising a HealthTech investment in 2025 and beyond?
Sure. Should I start?
Please go ahead.
So my name is Assaf, Barnea. I'm running Sanara Capital and Sanara Ventures. I'm based in Israel. We started actually as a joint venture between Philips and Teva in the two funds, actually investing in the two funds, investing in digital health, medical devices, and bioconvergence technologies, having about 20 portfolio companies at the moment. Our focus is areas which in some cases could be synergistic to Philips and Teva, but in so many cases not necessarily so. Aside from the Sanara, which I've been running for the last decade or so, and the new fund called Sanara Capital, which we are doing post-incubation investments, A and B rounds, having 9 portfolio companies at the moment. Aside from that, I'm running the chairmanship position in the Israeli Export Institute, the life science operation of the Israeli Export Institute, trying to promote about $10 billion of life science export out of Israel. In the background, I've been a consultant to the World Bank, to the venture capital team of the World Bank, and did a few other innovation platforms and supporting innovation platforms globally.
Mm-hmm. Thank you so much. Anne?
Hello, my name is DeGheest. Can anybody hear me? And first, thank you for being here. Best panel. You don't know yet, but trust us. I'm based in San Francisco. I run 2 companies. One is HealthTech Capital, which is an investor group made out of accredited investors, VCs, and corporate VCs. And we have invested in over 60 companies. Personally, I'm the serial entrepreneur and pioneer of HealthTech. I coined the word in 1986. Hopefully some of you were born. I'm just kidding. And so I've basically had the pleasure of building several unicorns in that space before it became fashionable. Mm-hmm. And I have another group called MedStars, which is an advisory company that works with company all the way to Israel, and I think we met in the past.
Yeah, we did.
And in Europe, also work with PMV in Flanders, which is an investment group in Flanders.
Thank you. Vickram?
Yeah, thanks everyone for being here. Real pleasure to be with all of you guys as well. So my name is Vickram Pradhan. I'm with a firm called Sopris Capital. I've been investing in healthcare technology companies for a little over a half decade. Our group focuses on services to software, so no life sciences or medical devices. Everything else is pretty much fair game. We typically invest at the Series A stage. And we're a little bit unique in the sense that we are an institutional venture firm, but we are backed by a single source of permanent capital. And that's a single family office. So look at the world a little bit differently than maybe a traditional venture fund would look. Certainly have had a lot of experiences across the healthcare spectrum. We've got something on the order of 25 portfolio companies and continuing to invest in promising, interesting areas in the sector.
Mm-hmm. Right, so diving into the topic, obviously the 23 and 24 were pretty challenging. For companies to raise funds at different stages, seed, or especially when we talk about Europe, the growth stage continues to be a big challenge. What would you say is, let's say, the reason and on the top of the mind of the investors when they are evaluating? Why do we see that the funding rates were kept low 2020 onwards, and is there any sign that we can actually expect this to change as of 25?
Yeah, I think we all know it, and it's repeatedly been stated that, it's a cyclical nature. Mm-hmm. And everybody's getting into panics and saying there's no investment, but this will come back. Eventually, VCs are investing, and actually we are now in a better situation because valuation is dropping down. We've been seeing, not just in Israel, but across Europe and the US companies, like for those that we've been seeing, like with $60, $70 million valuation, now dropping to 30, 35, down rounds, which are severe and which are tough for the entrepreneurs, but it's a necessity. So I think within that cyclical nature, we need to understand that startup companies, they need to understand that the bar has raised itself regardless to whatever they've been offering, but they need to react to that. Entrepreneurs need to address that and make sure that fundamentally they have all those that are requirements of, business model, let it not be delayed. You cannot just postpone the business model and come up with a so-called feedbacks of 1 or 2 hospitals that say, oh, this is interesting. This we should not accept. We may have, I'm not sure that Sanara would, but we may have accepted it some 2-3 years ago, getting excited from a very disruptive technologies, but especially in digital health is based on business models, validated business models. And you won't be able to fundraise if you don't have a solid and viable and validated business model. Regardless to the technology, regardless to the team, regardless to the market potential, this is for digital health. And the same goes for others. We invested in a company just recently, 2 or 3 months ago, with a company called DeGheest for back pain company, alongside Supernova from Paris and alongside Bold Capital from California. And we have scrutinized the company. It's a disruptive technology, not just stopping the degenerative process of the disc within the back, but rather stopping the damage and reversing the damage, which is unheard of. So we love disruptive technologies. We love to see that, and we're always, as VCs, we're raising the bar, even on the medical device side, seeing, first in human and how you can mitigate your risks. But I think startups and the management teams should truly understand what does it take now for us as we are scrutinizing even tougher those elements which we typically look into, but cherry-picking the best companies to come. This will be probably for the next year at least.
Right, so that's good news for investors, not so good news for the founders, optimistic.
Good news for everybody, actually, because it actually surfaces the good companies, and good companies will survive.
Of course.
Yeah, I mean, it's not that we're correcting. We're back to where we should have always stayed. Mm-hmm. And so if you look at funding there in medical devices, there was a bit of a bubble there because of HealthTech going crazy. But, I mean, the question we're asking is that, does it work? Who's going to pay, and why? A normal question to ask. It's just during a period of 2 years, we forgot to ask those questions because the market pressure was so high. So right now, half the deals in HealthTech, for example, in the US are unnamed round. It's all down round, extensions, and bridges. It's because the valuation were too high in 2021, 2022. Mm-hmm. So if people had $9 million in revenue and they had valuation of $200 million, there's no way they can grow into that value within 2 years. So ironically, people who raised this money were bragging they had this huge valuation. They just got wiped out. And I warned them about that, but now the reality has settled in there because the selling cycle to hospital is 1 to 2 years. The selling cycle to payers is 1 to 2 years. You are not changing that. What you had is an exuberance, the same way we have for AI right now. And now we're back to the basic business. How big of a problem is it? Who cares? Who are the stakeholders? And the last thing you ask is the technology. People don't buy technology, they buy a solution to a problem. And the problem of healthcare is multiple stakeholders. And unless you have value propositions for the nurse, the patient, the physicians, and the payers, whoever that is, you don't have a business model. So I think, we had this correction there that was because it should have never happened. Mm-hmm. So it's not that things are getting worse. We're back to business, which is we're building businesses that are sustainable.
Right, so I wanted to ask you about, does this point about the cyclical nature of this resonate with
Well, I mean,
with
this
your
interesting
experience?
report that just came out from Carta and other places is that the venture industry as a whole is minus $60 billion this year. That means they're investing $60 billion more than they're raising. So that's not sustainable. It's the worst it has ever been in the history of the venture industry. So right now you had a lot of people raise a ton of money in 2022, 2023, and they're using it, but the problem they're having is that they have to support the existing portfolio company. So the nightmare for people like you is to get a fresh term sheet from new money. That's the difficulty of it. The good news, if you can, you're going to be a very big successful company because historically, when we have this correction like that, the company who survive are the ones who are the most successful with huge returns. Huge return because there's only few of you funded as opposed to 15 competitors, which is what we used to do. And then number two, we get better return because we have a lower valuation because the market is more competitive. So I think this is the best time to invest as far as investors. It's the worst time for fundraising for you guys. But if you can make it there, you're going to build bigger companies.
I think a fundamental insight about the market is that just the marginal buyer is disappearing. And I think a lot of folks who've been deploying...
I call them the tourist investors.
Yes, I think a lot of folks who've been deploying venture capital over the past cycle, call it, maybe viewed themselves as investors, but if you look at what they were doing, it's more like momentum trading, right? Because you're looking for that next marginal investor to come in and take on the Series B and the Series C and the Series D, and the extreme version of that is the crossover funds that come in before the IPO because they see an arbitrage opportunity once that liquidity opens up in the offering. So when that starts to go away, when the IPO window closes, the Series D is not happening, the Series C is not happening, and so on, you have this cascading effect where I think companies get stuck because they're looking for that marginal buyer and they're just not there.
Yeah, you have a great point. I mean, they've shown that we've gone from 15,000 investors to 10,000 in 2024. That means a third of the people left the space.
But what we are seeing also is that there still is a marginal buyer for high quality businesses, and what we typically think about with respect to that is cash flow. There's still a buyer for yield. There's always a buyer for companies that are profitable. And so I think that's the dispersion we're seeing. Companies that are not profitable, that don't have the business model, to your point, are really struggling. Companies that have cash flow, maybe the valuation paradigm has changed, but there are still exits happening, liquidity events happening, and buyers at the table.
And I could bring a very good point there. There's a new category that's being created right now. We're living some history in the US where since there is no IPO and very little M&A because the large strategic have their own sets of problem there, private equity has moved in and they're buying company. They don't buy the whole company. They buy 67, 70% of the company. We had an exit this year. And then they give a chance for early investor like us to basically sell our shares. They're creating a liquidity. Sequoia Capital, which is a very big venture firm, has created a new fund. So they could buy their fund that's 10 years old because they need to get their liquidity on the earlier funds. So we're creating this new category there to provide liquidity from late stage investors. And I'm talking companies who have $30 to $50 million in revenues who cannot get acquired from right now. And that is not changing the equation there because the industry has no liquidity, and that's the problem right now. We need to find liquidity to be able to reinvest the money. And the LP are not investing because they're having no liquidity. They're overextended in venture.
But I think just to add on that, for those in the crowd who are entrepreneurs and running companies, basically they are, need to be creative in terms of sourcing. Not just us, the VC community. There are various investors out there, those who can bring non-dilutive equity. This is like the European fund. Even the strategics, definitely the strategics, even though it takes quite a bit. Try to be creative, not all of them, but anything that could be a build-to-buy model, various models that could be applied for early-stage companies or later-stage companies, which typically may not be the course, but in order to survive, you have to follow up on that and explore every opportunity in order to survive. So either strategics with various models, structured deals or whatever, even though it could be a little bit too early, and non-dilutive capital and various sources of consortium or partnerships, like in some cases VCs could create, just this morning I heard about one of those examples, unifying two companies into a holistic solution. This is something that we need. We need to see as the VC industry, we need to see more holistic solutions rather than I would not say a vertical solution that would not be enough when you come to sell to hospitals in the US and whatever. They've been flooded with tons and tons of companies and opportunities, and they will not, even though they may say, not just in the US, but everywhere, they will say, interesting, eventually they will come for a larger solution, an holistic solution. And as such, startup companies, if and when, and it could be doable in some cases, not in all of the cases, potentially you could merge with another startup company and create something, and putting aside the equity position, but in order to survive, do be flexible on the equity side and try to maybe solidify the more holistic, unique proposition with unifying solutions, unifying technologies, different layers of technologies. And this could happen. I'm not saying 90% of the cases, but in some cases. So aside from us, which we love to see opportunities as the VC community, but it is essential to explore other venues for funding.
But in what you are saying is essentially sort of a back to basic entrepreneurship 101, right? Fall in love with the problem, not with the solution. We are looking for excellent solutions that are really addressing the unmet needs, but there's also another wave coming with, let's say, technological advancements that still need, we are quite early on, so for them, and speaking to the entrepreneurs, speaking about, oh, you need traction or you need, validated business model, while those business models do not exist today, because simply this is not where the system is. So how do we cross this?
Well, I think it's more complicated than that. So medical device is very straightforward. Medical device and health tech are like two different planets. Medical device has stabilized, as there's new investment coming in there, because these are ultra specialized investors. They are long-term investors. They're basically focusing on what's called a product risk, going after an existing market that has been proven was a better product. Health tech is the reverse. It's usually a low product risk. It's usually software and run-of-the-mill hardware. But then what you have to do is that you have to create a new market. And one of the things in health tech, and I'm going to talk about this next week in Belgium, is that there's 100 different business models. And each one is very different, depending on what you're selling. You don't want to do capital equipment. You don't want to do per use. What you go at risk. And so right now what's happening, at least in the US, which I think is coming to Europe, is that just selling a seat on a per use, so every time I take a drink of water I have to pay for it, doesn't work. It used to work maybe 5 years ago. Now it's going to be at risk. Well, I'm only going to use when I'm dehydrated, and I'm only going to use it when I'm dehydrated and I'm diabetes, and I'm going to be at risk that I won't have less complication of diabetes. I'm just making this up, but that's where we are evolving the business models. So as the payers are getting much more powerful, and they say, I'm inundated with startups, they say, well, what do you do for me? And are you willing to go at risk to prove that what your value proposition is real? So I'll pay you the minimum to deploy it, and I'll pay you, maybe if the patient loses 5% of their body weight after 12 weeks, I'll pay you more. That's where we're going. So I think people need to understand that there's a risk transfer going on, and pretty much they're putting the risk on the startups and the companies, as opposed to the payers and the providers.
And I would also add to that, learn from your mistakes or others' mistakes. I mean, it is okay to pivot every now and then to have a core technology and not necessarily focus on the first use case that you've been following for the last 2 or 3 years, or even the one that you set up the company with. Not necessarily so. In so many cases, you may go, or you should, pivot into a different solution. But I think, then again, going back to what Anne said about the business model, there has been companies that were creative enough and were able to come up with a unique business model, especially now with the AI coming into the picture and having the FDA approving every now and then various use cases with various approvals. This is quite unique. Don't be afraid in order to explore other venues of approval and reimbursement and certification or validation by, both by the FDA and others, because that may eventually save the company's lives. And I think the AI forces us to see, the various venues for that to happen, which eventually this will happen. There's no way to stop it. Despite the failure, and there's been a few discussions, not just here, but in others about digital health, not proving itself enough, but it's out there for sure. And AI, and this will be a game as the banking industry has been changing and the automotive industry. This is here and now. Just we need to navigate and be creative enough, both in terms of reimbursement, both in terms of regulation, both in terms of the commercial side of things.
Right. So as we have in all of this, in the complexity in the system where we are innovating or where we are operating with multiple stakeholders, as you mentioned, and the entrepreneurs. So if we could turn the last minutes of the conversation towards, let's say, the actionable advice or a point, and I think that you mentioned quite a few already, but Vickram, if you would be to say, okay, this is the most important thing, or that you should be focusing on if you are looking to raise in this environment, what would be the advice that you would give to the entrepreneurs?
Yeah, I mean, I always caution entrepreneurs to take VC advice with a big grain of salt, because this is an industry where people are lauded for being right like 5% of the time. So I wouldn't say that our advice necessarily is gospel, but I think the most important thing is just going back to kind of the unifying thread of all of our comments is, focus on building the best business that you can. I think a lot of times folks are wondering, what do VCs want to see for my business to get funded? And I think that's kind of the wrong way to look at it. The way you should look at it is build something that you have a lot of conviction on, because I think ultimately for investors, the way that investors make a big return is by making a non-consensus bet that becomes obvious during the period that they hold the investment. So if there's one tangible or tactical piece of advice I could give is, I think a lot of people try and sort of form fit their company to the prevailing trend that they're seeing in the market because they think that's top of mind for the investors. But one way that I think you can really distinguish your pitch and your company is by talking about what you are doing that is non-consensus or non-obvious in that category and why that's going to yield a lot of great results, right? Because I think that is how you can basically tell the story that that investor needs to tell to their stakeholders, to their investment committee about how this investment is going to be a great, fund returner for the group or a big deal for the firm. So focusing on what you're doing that's non-consensus or contrarian that's going to become obvious over the next 5 years, I think that's a great way that you can sort of distinguish yourself and make traction as you have discussions with investors.
So I would say, what is the problem you're solving? Is this a big problem? Are all the stakeholders aware that they have that problem? Is there a sense of urgency? Is this a big deal for them? And there's a lot of cool products there, but it's at the bottom of their list. So really spend more time on the problem. If you are in non-regulated, i.e. no FDA there, go out there and talk to all the stakeholders from the viewpoint of each of their perspective. Maybe great for the doctors, but the nurse hates to use it because it increases her workflow. Maybe great for the physician, but the patient refused to basically check their blood pressure every 10 minutes. So, how is it going to be used? That's where you start your presentation to say, what is the problem I'm solving? What's the benefits that will come out of it? And then if we still buy that, then you can tell about the technology and how you do it. What I see is people exactly do the reverse. They say, look at my cool technology, and oh, by the way, we have all this clinical application. We're going to go to the payers, the hospitals, the this and the that. It's impossible to be ultra-focused there on people buy solution to a problem. They don't buy technology.
I would add one word, listen.
Tell me more.
Exactly. Listen. Product market fits. Listen to what, the feedback is there. Pricing, listen. It is so crucial. In terms of competition and competition analysis, we've been using buzzwords all the time, unique value proposition. This is not just words. Unique value proposition, it has to be unique, there has to be a value, and the proposition should be solidified. So I think along the course of fundraising, we've been talking to dozens and dozens of companies, and we, as a VC, we love those that can truly listen. You see the feedbacks. Eventually, we're building up partnerships between people. With all due respect to the technologies, we are building up partnerships between us, trying to bring few of those companies to big success. But those partnerships are being built with the chemistry between, founders and VCs or others. And eventually, it's a dual due diligence. You guys, the entrepreneurs, should run due diligence on us as well. Who are the funds that are supportive, what they can do, aside from bringing capital to the loop. So this is where I'm saying listening to one another, truly listening, and echoing on what the feedbacks were, regardless to whether it was on the commercialization, on the go-to-market, on the product market fit.
That's a very important point, if I can build on that. There's a lot of companies are blowing up right now because they have the wrong syndicate. Do your homework. Find out, does he have an operational background and can feel the pain and suffering you're going through? Or they're like private equity guy who's just going to say, you miss your milestones, you're dead. A lot of people there have a history. Talk to the CEO on LinkedIn. Go talk to the CEO of this portfolio company. The best lead-in is the CEO of a portfolio company that says, I have to take this call from Tom, and we always take those because they're a portfolio company there. So there are ways to go to it. Do your homework. Your first job is to sell to investors. The second job is to sell to employees to follow you, even if you have no payroll to pay for 6 months. And the third one is the customer. Your job as CEOs is to sell. If you cannot sell us, there's a low probability that you can sell the customers. So you need to get yourself into our shoes, do your homework on us, find out, if you're the right background, the right fit, and tell us why we are the right investor for you. It's a two-way street.
Yeah.
I think the important point that you raised too is, I think it's important to understand what is your investor's incentive. To your point, a lot of the reason that the syndicates break down is because some people are shooting for $1 billion company and some people are comfortable with a much lower exit value because it's going to be a life-changing event for them. And so trying to understand what game the investors are playing is very important because you're going to be an integral part of that game, and it's going to inform the way that they give you advice and the type of outcome that they're underwriting to, which can be very instructive in this industry in particular.
And then board dynamics, we can write books about it. But if you have a VC that's a micromanager is going to tell you what to do for the next 7 days versus somebody that basically returns phone calls every 3 months, you have a problem at your board. And so really, it's like getting married. I hate to tell you, they can't fire you, you cannot fire them. I mean, if I can make that joke. And so it's really important you do your homework. Don't go for the highest valuation. People who have done that are now in deep down rounds. Go for the people who are builders.
Right. And with this optimistic note, and I'm really glad that we actually have heard a lot of common knowledge, I would love to say, for people who have been around and who are trying to build things through. It's not a revolution that we can expect that the world is ending in 25 or that we are in a crisis of some sorts. I think what comes through the conversation is that essentially it is a correction that was very much needed. And there are definitely things and lessons learned from the past that we can look forward to implementing as of the new year. So thank you so much
Indeed.
for
Pleasure.
the conversation.
Thank you, guys.
Thank you,
Bye-bye.
everyone.